Hi, this is Dean Mead from the Governmental Accounting Standards Board and the Rutgers Business School. The subject of this presentation is the accounting and financial reporting standards for deferrals under GASB Statements 63 and 65. The presentation will begin with some background so that it is understandable why, at this particular point in time, the GASB has established these standards related to the reporting of deferrals, including talking about what the definitions of deferrals are under GASB statement concept statement number 4. And then the bulk of the presentation will look at these two pronouncements, Statement 63, which talks about essentially the geography of the statement of net position and where deferrals should appear, and then Statement 65, which identifies things that traditionally have been reported as assets and liabilities, but that going forward should be reported instead as deferrals or as current period inflows or outflows. Path towards Statements 63 and 65 began with GASB statement concept statement number 4. GASB concept statement number 4 defines elements of financial statements, or the things that are reported in financial statements. In a statement of financial position, like a balance sheet or a statement of net assets, the GASB identified 5 distinct elements: assets, liabilities, deferred outflows of resources, deferred inflows of resources, and net position, which is the cumulative amount of all the other elements reported in a statement of net position. Now, I think most people would have expected to see assets, liabilities, and net position, but for a lot of people, deferred outflows of resources and deferred inflows of resources were something of a surprise. But what the board found as it was looking at the things that are reported in statements of net position, statements of financial position, was that there were certain things that just didn't meet the definition of an asset or a liability, and yet were still reported there. And there was something else that those things were, and what those things turned out to be were deferrals. And that's the way, for the most part, during this presentation, I will refer to them rather than saying deferred outflows of resources and deferred inflows of resources, unless I'm talking about one or the other. When I'm talking about them as a group, I will refer to them as deferrals. Now, as a practical matter, that identification of elements in a statement of financial position differs from what GASB Statement 34 requires for reporting statements of net assets, which include assets and liabilities and net assets, but do not include deferred inflows of resources and deferred outflows of resources. So as a practical matter, the board needed to do something to reconcile that reporting under Statement 34 with what concept statement number 4 said should be the components, the elements of a statement of financial position. At the same time, the GASB was issuing accounting and financial reporting standards that required the reporting of deferrals. Statement number 53 on derivative instruments requires that the year-to-year changes in the fair value of derivative instruments that are effective hedges should be deferred rather than reported as investment income in the period in which they're incurred, and will continue to be deferred over the life of the derivative as long as it continues to effectively hedge the cash flows or the changes in fair value that it was established to hedge. Statement 60 on service concession arrangements requires that any upfront payments made to the government as a part of a service concession arrangement should be reported as a deferred inflow of resources and then recognized as revenue over the life of the service concession arrangement. Now, what GASB didn't do in these pronouncements, because it wouldn't have been appropriate there, was tell people where they should be reported. And so that's the GASB, at a minimum, needed to answer that question because it was coming up quite a bit in the technical inquiries that the GASB was receiving from financial statement preparers and auditors. One of the primary motivators for Statement 63 in particular was that the GASB needed to solve this practical dilemma, deferrals were required to be reported under 53 and 60, but Statement 34 didn't allow for them to be reported in the Statement of Net Assets. But there was a bigger issue as well that came from Concept Statement number 4. One thing that GASB said in that concept statement, because the board was concerned that governments might take it upon themselves once they had these definitions to identify for themselves what things in the statement of financial position were deferred inflows or deferred outflows of resources, and then just start reporting them that way. And that would have created a substantial comparability problem, because some governments would have done it, some governments wouldn't, and some governments might not have done it properly. So GASB very specifically in concept statement number 4 that governments should only report deferrals that are specifically required under generally accepted accounting principles. Now, by doing that, the board also essentially committed itself to going through the really massive exercise of determining on behalf of its stakeholders what things in the statement of financial position that were being reported as assets and liabilities really were deferred inflows of resources and deferred flows of resources, and that is what led to GASB Statement 65. So what are deferrals? Deferred outflows of resources, the technical definition from Concept Statement 4 is that they are a consumption of net assets by the government that is applicable to a future period. So this is like an expense or an expenditure, but rather than being applicable to the period in which it occurs, it's actually related to a future period. And so essentially what a deferred outflow of resources is not a deferral of the outflow. The outflow has taken place. What is being deferred is recognition of that flow as an expense or an expenditure. Likewise, a deferred inflow of resources is not a deferral of the inflow. The inflow of resources has taken place. You've already had the acquisition of net assets, but rather than it being related to the period in which it happened, it's related to a future period. And we'll see some examples of that, and so you'll understand clearly what that means. But essentially, these are, in terms of what heard, are just like inflows and outflows of resources of the current period, but they're not related to the current period. They're related to a future period. And so until you reach that future period, you are going to report them as deferrals. And then when you reach the period to which they're applicable, that's the point at which you recognize the outflow as an expense or an expenditure, depending upon what basis of accounting you're using, and as a revenue. The deferred inflow of resources would be reported as a revenue. In the interim, while these things are resident on the statement of financial position, a deferred outflow affects net position the same way an asset does. It is a positive impact on net position, and therefore when you report it as an expense or expenditure in the future, it's at that point that net position is reduced. A deferred inflow of resources has a natural credit balance. It would decrease net position much in the same way a liability would, but then in that future period, when it's appropriate to report that deferred inflow of resources as revenue, at that point, net position would increase the way it does when a revenue is recognized. And then net position is defined as the residual of all the elements presented in a financial position statement. Before the reporting of deferrals, the accounting equation that was laid out in a statement of financial position was assets minus liabilities equals net assets, or assets equals liabilities plus fund balance under modified accrual in the governmental funds. But based on the fact that deferred outflows have a natural debit balance and deferred inflows have a natural credit balance, the accounting equation now under accrual is assets plus deferred outflows minus liabilities minus deferred inflows equals net position. And under modified accrual in the governmental funds balance sheet, assets plus deferred outflows equals liabilities plus deferred inflows plus fund balance. That background in mind, let's take a look at Statement 63, which was primarily intended to answer the question, where do these deferrals appear, where should they appear in a statement of financial position? Statement 63 is effective for periods beginning after December 15th, 2011. So we're talking about fiscal years that began on January 1st, 2012, and ended December 31st, 2012, so a little bit more than a year ago. So governments with a calendar year, fiscal year, should have already implemented Statement 63. Governments with a June 30th fiscal year end would have implemented this first for their fiscal years beginning July 1, 2012. In other words, those that end June 30th, 2013. So many of those governments also, especially the ones that prepare a CAFR and have to have that done within 6 months in order to get the GFOA certificate for financial reporting, will have already implemented Statement 63 as well. Some other governments with June 30th or later fiscal year ends that are still working on their financial statements, are in the process of implementing it. What Statement 63 requires is very straightforward. It essentially says deferred outflows of resources should be reported in their own section of the Statement of Financial Position, separate from assets, and deferred inflows of resources should be reported in their own section, separate from liabilities. So you'll have 5 separate sections: assets, then deferred outflows of resources, then liabilities, then deferred inflows of resources, and the last section then is net position at the bottom of the Statement of Financial Position. Governments are allowed to report a subtotal line that combines assets and deferred outflows of resources, and one that shows the combination of liabilities and deferred inflows of resources. Originally, when GASB proposed Statement 63, it said that governments could not do that. And then a number of the commenters on that proposal said that it would be helpful to some governments to do that. They ought to have the option, and that there really wouldn't be any harm in doing it as long as deferred outflows were in their own section and had their own subtotal first, and deferred inflows were in their own section and had their own subtotal first before being combined with assets and liabilities in an additional subtotal. And the board accepted that argument and agreed that there really wouldn't be any harm in at least allowing it as an option. Net position then is essentially reported exactly the way that net assets is reported, in 3 components, with a slight change in the name of the first component. Rather than being invested in capital assets net of related debt, that first category of net position will now be called net investment in capital assets. But the definition is exactly the same. It's the government's capital assets minus any outstanding debt that was used to finance the construction or purchase or rehabilitation of those capital assets. Restricted is still defined as it was defined before. Unrestricted is still defined as it was defined before. The same level of detail requirements are still in existence. The only difference is that net position takes into account the effect of deferred outflows of resources and deferred inflows of resources as well. This is what a typical statement of net position would look like, and you can see that there is a separate section here for deferred outflows following the assets, and a separate section for deferred inflows following the liabilities. There's only one example in each of these. Both of them happen to be deferrals that are related to Statement 53 on derivative instruments, because at the time that 63 came out, Statement 53 was the only pronouncement that was in effect at that time that required the reporting of deferrals. Subsequent with Statement 60 coming out on service concession arrangements, Statement 68 on pensions that came out in June of 2012 that requires the reporting of deferrals, and then, as we will see with Statement 65, where a number of things reported as assets and liabilities will now be reported as deferred outflows and inflows respectively. There will be more items in those deferred outflow section and deferred inflow section than there are in this illustration. And here is the net position section. It should look to you exactly like the net asset section looks. You can see that restricted net position is shown by purpose of restriction. Unrestricted net position is the last line. The first line, net investment in capital assets, that used to be called invested in capital assets net of related debt. That should be very familiar looking to you as it is. 63 also included a couple of disclosure requirements. First of all, if the government has aggregated a number of deferred outflows of resources or deferred inflows of resources that in a way that masks important distinctions between types of deferrals or reasons for deferrals, then the government should present in the note disclosures some breakout, some disaggregation of those different types of deferred amounts. This is very similar to what the standards require for accounts payable or accounts receivable, for capital assets, for long-term liabilities. In each of those cases, there are note disclosure requirements to show more detail beneath the aggregated numbers that are shown on the face of the financial statement. The other disclosure is that if one of the components of net position is significantly affected by deferred inflows or deferred outflows of resources, then the government should include a note disclosure that explains the nature and magnitude of that effect of the deferred inflows or outflows. So that, in a nutshell, is Statement 63 and the answer to the question, where should deferrals be reported in the financial statements? Statement 65 is the outcome of the GASB's effort to identify things that in the past have been reported as assets and liabilities in a statement of financial position, but that in fact don't meet the definition of an asset and liability, that actually meet the definition of a deferred outflow of resources or a deferred inflow of resources, or as the board came to find out as in going through that process, certain of those assets and liabilities really should have been reported as outflows of resources of the current period or inflows of resources of the current period. Statement 65 is effective for periods beginning after December 15th, 2012. So we're talking about fiscal years that ended December 31st, 2013, so the ones that just ended, and later than that. So any fiscal year ending after this point, a government would be required to implement Statement 65 for that financial year, for that fiscal year. Governments with June 30th fiscal year ends then are in the year for which they're going to implement, and will implement it then after June 30th of this year. The board took a very specific approach to looking through all of these existing asset and liability balances that were already required by governmental generally accepted accounting principles. And it's worth mentioning this both so that you can understand how the board came to the decisions it came to in Statement 65, but also because the board decided that going forward, as it set standards, that this would be the approach it would take in analyzing transactions for which it is considering setting standards in order to determine what the outcomes of those transactions are in terms of recognition in the financial statements, whether they result in assets or liabilities or deferrals or inflows or outflows. So the first thing that the board did, and what it will do in standard setting going forward, is ask, do these items meet the definition of an asset liability? If they didn't, then initially what the board thought would be the case was that that would mean that they were then either a deferred outflow of resources or a deferred inflow of resources, respectively. But what they found out was that certain of those items, not only are they not assets or liabilities, they weren't deferrals either. They were, in fact, current period outflows of resources and inflows of resources. So, if an item doesn't meet an asset or liability definition, it doesn't meet the definition of one of the two types of deferrals, then it is either an outflow of resources or an inflow of resources of the current period and ought to be reported then as an expense or an expenditure or a revenue, respectively.